We actually think that retirement security and household level financial security is a societal issue, that really it's in all of our best interests that households are financially secure, because we know that that resilience creates stronger economies and stronger democracies.
Pilots or policies have been rolled out that give people the chance to save, and even the most modest of incentives to do so. They actively do so, and then they tell you that they're really pleased afterwards that they have done.
You're listening to Life 2, a podcast from Don Ezra and Commonwealth. Don Ezra is a former co-chair of Russell Investments Global Consulting and creator of the retirement website donezra.com. His latest book is Life 2, How to Get to and Enjoy What Used to Be Called Retirement. Commonwealth is a mission-driven business that works with associations, unions, and employers to provide collective retirement plans, and has been recognized internationally for its work in expanding access to retirement security. On Life 2, we take a tour of the retirement life cycle, from the time you start saving to your retirement years, while also taking a look at the Global Retirement Challenge. Each episode features an in-depth interview with a leading expert on the topic, followed by The Personal Touch, a segment in which Don breaks down these expert insights and how they might apply to your personal situation. Keep in mind that the podcast is for educational purposes and should not be considered investment, tax, financial, or other professional advice. We start off the episode with Don Ezra and Commonwealth's founding partner, Alex Mazer.
Throughout our podcast series, we've learned about the many challenges within the retirement field, both personal and collective. Today, we hear from two acknowledged leaders who observe the global scene, each also with much hands-on experience in creating innovative practices.
Ida Rademacher, Vice President of the Aspen Institute and Executive Director of the Aspen Financial Security Program, joins us from Washington, D.C., along with Will Sandbrook, Executive Director of Nest Insight in London, UK. Together, Ida and Will lead the Aspen-Nest Insight Transatlantic collaboration, a partnership dedicated to helping to solve the next generation of retirement challenges. Well, welcome to the show. It is fantastic to have both of you with us. And I thought we'd start the way we usually start, which is to ask the question, how did you first become engaged in the topic of retirement security? And maybe we'll start with Ida and then go across the Atlantic Ocean to Will.
Thanks, Alex. I got started in retirement-focused issues primarily because I had been a researcher around a lot of the financial lives of low-income households. And when you start looking at where wealth actually resides on the balance sheets of low and moderate income households, the only place there is net worth is in home equity and increasingly retirement savings, as that came into being as a function in both US and other markets. So when I thought about primary issues of building wealth, how do you actually build the balance sheet and the wealth of households so that they have resilience and choice, the retirement system was a necessary place to understand and to engage in. And it's, really opened up a whole world to me of other important aspects of that system in general, but how that contributes in the future to financial stability and financial security of households, especially when home ownership is becoming even harder in the US and other places.
And how about you, Will?
So my answer is a lot less thoughtful. I mean, I got here almost completely by accident. I applied as a new graduate to the UK government's kind of graduate training scheme, and you get put where you're put. And I was initially put in the tax policy area, and I managed to push back against that. But pensions policy was next, and I couldn't push back twice. So I dutifully went off to my first day on the job working on pensions policy, and in a very short time was completely hooked by it as this topic, which had been completely invisible to me until then, and I guess is still invisible to a lot of people, and yet is sort of deeply complicated and very, very enriching when you get it right. So I landed here by accident, but I've stayed ever since, and I'm very happy that I have.
And how did Nest and Aspen get together?
Oh, that's a long story. We probably require a cocktail. No, I'm kidding. Will actually, I'm wondering, do you want to say, I'll say a little bit. I often like to say that the U.S. is a great net exporter of good policy ideas. There's a lot of early work in the U.S., as I'm sure we'll talk about, with the ideas for automatic enrollment and automatic escalation from behavioral economists. But we'll have to look elsewhere in the world to see who's actually trying to put those ideas into action. And so that's really where Nest comes in, and was excited about all that they were doing. And Will, maybe you can take it from there in terms of how we decided to team up.
Yeah, so I mean that's absolutely right. So we, I think originally actually I came across to Oregon to talk about progress with Nest to some people who were involved in the early days of the Oregon Saves program. I was invited across by Ida and her team to talk a bit about what we'd found, and we just found from there that there was a huge amount of overlap in the topics that we were interested in and that Ida's program were interested in, and then along the way, as we got more involved in some of the debate in the States, we wanted to more formally find a research partner who we could work with on a longer term basis there, to give us a bit more of a kind of foothold in that area and an understanding of that area, and really the financial security program were the obvious candidates for that, and so we've sort of built out the relationship from there.
One of the reasons we're really excited to have you on the show is I think both of your organizations are doing some of the most innovative and interesting work in thinking about the future of retirement systems and being really, I think, creative in trying to come up with solutions and bring people together around solutions to this issue. But I don't think we should take for granted that people kind of know about the work that you're doing. So I thought maybe each of you could kind of describe what it is that your organizations do, and maybe starting with you, Will. So starting from the basics, what is Nest, and then what is Nest Insight?
Yeah, of course. So Nest is a pension provider, a pension plan provider. We're structured as what we would call a master trust. So it's a sort of fiduciary management corporation that can be plugged into by any employer wanting to use Nest as its provider of workplace pensions. We were set up we launched in 2011 as part of the broader program in the UK to introduce an automatic enrolment mandate on employers, really with the idea that there needed to be at least one plan in that market who could accept any kind of employer and any kind of saver, irrespective of their income or the size of the employer, to make sure that there was a good option available for all those employers as that mandate rolled out. So we very much have a focus on low and moderate income savers. We've grown to about 8 million members now as of 2019. So that's Nest. Nest Insight is a program we set up in 2016 as the kind of in-house think tank or thought leadership and research brand within Nest. So really we focus on trying to do things, research, discussion events to shed a light on how can we try to make sure that the UK retirement system works as well as it can for those low and moderate income savers.
So a couple of things I just wanted to build on there. Will, you passed over this quickly, but 8 million people, remarkable number. And the vast majority of those are people that did not have a workplace pension or workplace retirement savings arrangement before. Is that correct?
That's absolutely right. So there'll be people passing through employers who didn't used to offer something to their employees. Yeah.
And then the other thing I wanted to mention is just to recommend both Nest and Nest Insight as a source. We were talking, before we started recording. Just a great source of research. I mean, one thing that Nest does, because it's a public purpose organization, is it makes public a lot of its research on member behavior, on its investment program, on all sorts of issues that are core to the design and implementation of retirement savings programs and systems. And it makes those broadly accessible for free, to anybody. So I just encourage people to take a look if you haven't already sort of taken advantage of that repository of material, to take a look at the Nest and the Nest Insight websites for material. And maybe we can come back across the Atlantic to you, Ida, and talk a little bit about the Aspen Financial Security Program, and in particular the work you do around retirement security.
Yeah, sure. So I came back to Aspen about 4 years ago, and there had been an ongoing program, the Financial Security Initiative at Aspen, which had primarily looked at retirement issues. My own background, as I mentioned, was primarily looking more at specifically low and moderate income households and what was changing about the drivers and dimensions of financial security in their lives. So when I came to Aspen, I wanted to create a program that tried to square this conversation. We were having a retirement conversation, often about fixing a system, but not really inserting into the middle of that conversation what was happening and changing in the financial lives of those who were left out of that system. And so I thought that for the future of a retirement security issue at Aspen to be relevant and cutting edge and forward thinking, we'd have to really inject a lot more conversation and data and participants into that conversation that helped people understand what was going on in people's financial lives now, so that the next generation of problems that we were trying to solve felt relevant to folks that were in the retirement industry. And so a lot of that early work was bringing the work of books like the Financial Diaries into the retirement community's lexicon, understanding what was going on with income volatility in people's lives, what was going on with consumer debt. So over time now, the Financial Security Program at Aspen has embraced a mission of looking at the range of financial challenges that are facing households and trying to figure out how to build a bigger tent financial security field and solution where we're not looking in different silos at how do you solve the retirement challenge? How do you solve the consumer debt challenge? How do you solve, these issues of short and long-term financial security? Not sequentially, but by getting all the right people in the room together and starting to think about the changing nature of work and the implications of that for household financial security.
Yeah, one of the things that I think that you in particular and also your Aspen colleagues have a real gift for is kind of connecting the dots between these different elements of the financial security debate, and also convening groups of people that are not the usual suspects on this topic. And that's one of the both of those things are things that we're really passionate about, both at Commonwealth and on this show, is to try to kind of bring together different disciplines, but not get overwhelmed by it, to sort of say, there's so many problems, I don't even know where to start, but actually to start to chip away at it. And part of what I'm wondering is, who are the people, in your view, that have been left out of this retirement security conversation?
Yeah, I think in some ways it's the folks that we'd expect. There's, at least in the U.S., and I'll go back to the earlier statement I made, that if you look at who has wealth in the U.S., traditionally, if they have wealth, it's in the house or it's in their retirement system. But about 55 million Americans don't have access to a retirement plan at work. And this is one of the reasons, again, that we're really excited about the partnership with Nest, because the UK and the US both have a retirement saving system that is built around the employer. And so what we didn't have in the US is an access to those retirement plans for people who work part-time, people who are working in contingent relationships that aren't in a traditional, in the U.S., W-2 or formal employment system. But also, a lot of those folks are low and moderate income. It also means that there's higher incidence of lack of access to retirement in communities of color. Latino and African American households in particular lack access to retirement savings. And so there's the reality is they also lack access to any kind of emergency savings. And so, in some ways, our hope is that the next generation of retirement systems looks at the suite of challenges that we can solve by creating a more holistic and inclusive system. But the issues are real, and they spread far up the income ladder in the U.S. In ways that I think were also parallel to what Will and the UK stakeholders saw before they introduced automatic enrollment in 2012 there in the UK.
Yeah, I just want to come back to one thing I loved that you said in your introduction, was just talking about how you got into this topic, which was, I think the way you described it was seeing the retirement assets as an opportunity for lower and moderate income people to build wealth. And that's so different from and refreshing compared to the way that it's often looked at, which is, well, low and moderate income people can't save, they don't want to save, therefore, they're not part of really the conversation and don't need to be part of the conversation. You saw that very differently.
Yeah, and I'll think this is where Will can come back into the conversation as well. I think at least from where I started this, when you spend enough time with households who are making every dollar count, they are the most clear-eyed about the need for savings, about their desire for savings. Now, the systems and their current situations may not allow them to save. And other colleagues I've heard often say that assets matter fundamentally in different ways than income, but institutions matter in determining who builds assets and who doesn't. So this isn't just a matter of personal choice, it's a matter of system design. And we haven't had the right products and systems and structures to help low and moderate income households save with the same level of just structural design to that. Institutions behave really well for you and me. They don't behave particularly well for low and moderate income households, but that desire is there. And so part of what we could talk to or blue in the face that people might want to save, but we're always going to deal with that persistent doubt that you talked about, Alex, that maybe they shouldn't, maybe they can't, maybe they don't even want to. I think that all you have to do is start looking at what's happening in the UK and honestly looking at what's happening even in the beginning of Oregon Saves and some of the places where automatic enrollment is coming in the US to see a very different answer in the data.
I think one of the exciting things for someone who's been outside the system for a while, one of the exciting things to see is as you get people in, and we're talking about new ways of getting people in, which is absolutely fantastic, you also have other things that coordinate it all. For example, the experiment going on, I don't know if it's already started or not, with Nest on the sidecar, because it's important to save towards retirement, eventually towards the second life, as I think of it, life two. But we also have to live life one at the same time, and most people don't have emergency savings. And so the coordination of life one emergency savings and life two retirement savings is something that's now an experiment just starting, and that's absolutely huge and very important.
Yeah, I mean, I completely agree with that, and I think for us, the idea behind a lot of this is that those two lives are kind of super connected, right? So one example that gets given is, if you blow the tire out on your car and you can't go to work for a few days, and your work is driving a car, you lose some income. That's income you can't be making contributions from towards your retirement, and indeed it's an issue that you may have to fund through borrowing, which you may later repay through choosing not to pay money into your retirement savings. So there are all these kind of, many other ways in which your resilience in the short term is just really closely tied to your financial chances in the longer term. And that's really the motivating idea behind the emergency savings project that you mentioned. So we're trying to give people use the same tools that they've started using now to save through the workplace for their retirement, to also offer them those tools, payroll deduction in particular, to save for the short term. And hopefully what we'll see over time is that giving people that opportunity helps them in both lives. But I did just really quickly want to come back in on a part of the previous conversation as well. I think it's important to talk about whether there's a population of people who maybe shouldn't be saving all that much, particularly in terms of what they might expect to get from the first pillar of their retirement system. But this idea that there are some people, lots and lots of people who either can't or don't want to save, I think really is completely disproven by real world data. So multiple times here in the UK, most recently with auto enrolment, but also in non-retirement savings contexts where pilots or policies have been rolled out that give people the chance to save, and even the most modest of incentives to do so, they actively do so, and then they tell you that they're really pleased afterwards that they have done. And I think that's one of the big lessons as well from UK auto enrolment. People who are involved in it are much happier about retirement saving now than they were before they were offered it.
So one of the aspects that really thrills me in all this is that you don't just develop ideas and take ideas, you test them. It's the evidence-based approach that's so wonderful. You say, well, let's try it and see. And here's a conclusion you've come to about the way people actually behave as opposed to the way in which people who wave their arms say, here's what we think is going to happen, and you say that. And one of the other things that struck me that takes that a step even further is that you've started looking at what happens when you ask people not just to save, but to save more. Can you tell us a little bit about the escalation part of saving?
Yeah, when the auto-enrollment mandate was designed here in the UK, as Ida said earlier on, we looked a lot to the evidence from academia, particularly in the States, around sort of different behavioural interventions. And obviously the big thing we were doing was automatic enrolment, but we also looked at auto-escalation and built that into the policy. So the initial launch of automatic enrolment, people were only required to save a very low percentage of their income, 1% from the individual matched by 1% from the employer. And then once we got everyone in, we moved those numbers up over time. So last year there was a jump, and this April just gone there was a second jump. And so now people are at 5% of their salary matched by 3% from the employer. And what we've seen certainly last year, last April 2018, is that sort of gentle incremental increase meant that we lost very few people in terms of people stopping saving once the first rise happened, and it seems like that's the case this year as well, although it's a little bit early to say because the data is quite slow to arrive and we're still only a few weeks in to that second rise.
So I want to come back to the topic of expanding access to retirement security. And Ida, we've had an opportunity to collaborate on this question on a report around what we jointly called portable non-employer retirement benefits. But it comes back to this question of institutions. So we've had a system that's largely been organized around the employer. We know that that's either plateaued or been in decline, depending on how you look at it. The employer-sponsored pension plan is not something that is expected really to grow. So then the question is, in jurisdictions like Canada and the United States, where there are large swaths of the population, you mentioned 55 million people in the United States that don't have access to a workplace retirement plan, what are the kinds of institutions that could help fill that gap?
Well, we will crowdsource this answer together, Alex, and I know we've given it a lot of thought together. I think this is really one of those places for innovation. I do think that the employer is such an interesting nexus for the retirement system historically, and that what's going to happen going forward is really going to be worth watching. And I'll say just a couple of things about why I think that's important in this context of expanding access and also of wealth and wealth inequality, which I know isn't usually part of the retirement conversation. There's a whole other set of research right now happening that is showing kind of a tale of two employers. As high skill competition continues to figure out how to differentiate and attract talent, there are some employers that are going to continue to try to build the best possible suite of benefits to retain and attract high talent. And at the same time, there's a shifting of risk in an entire other segment of the employer market, including moving to contingent work, so that there's going to be a set of employees and workers going forward that have even less access to benefits and even less ability to manage risk for themselves. In the long run, that's going to lead to increasing, I think it already is, increasing wealth inequality. And some of the interesting research by people like Peter Orszag have shown that the actual differentiation among firms has as much explanatory value for what's driving wealth inequality as individual household choice and income. So I think that's really important to keep in mind, because what it says is that if we actually think that retirement security and household level financial security is a societal issue, that really it's in all of our best interests that households are financially secure, because we know that resilience creates stronger economies and stronger democracies. So if that becomes a social question, you can't leave it to chance that an employer is going to decide that retirement's in or out, or other parts of financial benefits are in or out. And so that is what really leads us to have to think about what are other institutions that can begin to step up and play that role? And can we remake and remodel existing institutions, or do new ones need to be created, or is it some combination? When we wrote the report with you all on portable non-employer retirement benefits, and if anybody's listening that has a better name for that for us, please, we're all ears. But I think right now describing what it is important. We certainly have seen nonprofits, associations. We've looked at some of the actual infrastructure, financial infrastructure, like payroll and platform companies. Could they play a role? Part of where we look for this is churches. Are there faith-based examples? And one of the things that you all did a great job with, Alex, and your team, was writing case studies, into the paper that really do show examples of all of these things operating, maybe not at the scale we need, but that the rails could be there for this kind of support. And then, of course, there's the other place we would look is when I think about new kinds of institutions. It's been helpful to look at the UK and Australia. When you look at master trusts and the superannuation groups, some of those are nonprofits. Some of those are government sponsored or had been union sponsored. And so, it's really, and we have a whole lot of principles that we talk about for how would you design this function in a different kind of institution than an employer? But given that people don't stay at their jobs over a life tenure anymore, given that the kinds of jobs and the number of jobs they have at any given time change, we're looking for some kind of institutional base for retirement that is more durable over time in terms of the relationship it'll have with the worker than the employers of today.
Well, Adi, you mentioned the case examples, and I guess Missouri is the show me state, and I think in a lot of ways, United States and Canada, these are show me jurisdictions. It's very helpful when you have actual examples that are real. And so I want to go back to Will and ask about, what is a master trust? What is a profit to members type structure? And it's a big question, but what's the role that institutions like Nest and other master trust arrangements in the UK can play in improving the system and contributing to innovation?
That's a lot of very big questions, but I'll make a start and then let's see where we go. So, a master trust is essentially an independent financial institution, pension-specific institution, with its own governance, usually a board of trustees, that can then accept or provide services to any employer as a workplace pension provider. So it's what in the USA I think would be described as an open MEP. I'm not sure whether Canada has an equivalent structure. It's a lot like an industry super fund in Australia. And it does, in a sense, kind of play the role, a lot of the role that I think Ida's just described. So it is a portable non-employer retirement benefit in as much as you may come to a master trust through an employment if your employer uses that master trust as a provider. But when you leave, your relationship is with the pensions institution, not the employer. You can keep paying into that account, and when you go to your next employer, they may also enable you to pay on into that account, or you can consolidate back into it later. So in that respect, it's a lot like the kind of model that you're describing, and it moves the employer into the role of selecting the provider, negotiating with the provider on terms, choosing to pay into the pension as part of their overall employee benefits package, but not having to be the fiduciary or the sponsoring institution in a formal sense. In terms of innovation, I think, to me, this is about creating institutions at scale that have a clear legal kind of binding connection to the interests of the end investor. So and that's where the profit for members thing comes in. So Nest is an example of these. It's not the only example by any stretch of the imagination, but our overarching responsibility is not to any shareholder, it's to the member. And if we make a profit in a traditional sense, then it has to go back into the member outcome in some way, be that through reduced charges or investment in some other aspect of the service. And so that, with 8 million members as a fiduciary acting on their behalf, we have pretty powerful bargaining power to build and negotiate for them a really high quality pensions product at very low charges that looks an awful lot like a large traditional employer-sponsored plan, but with the added benefit of going with you when you leave your employment and working even if your employer only employs you and a couple of other people.
Yeah, I mean, I want to make two quick points, before turning it back to Dawn. The first is in Canada, that sort of profit to member master trust model we've seen largely in the public sector. So we, for example, did a report with the World Bank about the so-called Canada model of public pension, and we interviewed many of the founders and initial board chairs and CEOs of plans like Ontario Teachers and Canada Pension Plan Investment Board, and they actually said the most important thing in the success of that model, which has been used as an example around the world and has been very successful in terms of delivering value for members, was what the governance model. And the governance model was really about aligning the interests of the organization to maximize the value for the member, having a fiduciary duty and having the right set of skills there on the board, which is sort of a different way of expressing it, but a similar conclusion. And a lot of our work is trying to expand that type of model outside the public sector. The other point I want to make is, we call it non-employer. We talk about other kinds of institutions, but there still is a very important role for the employer. And I like the way what you said, Ida, about kind of the tale of two employers. For those employers that are not interested in innovating on retirement benefits, don't want to be in the retirement business, they maybe want to provide a benefit, but they don't want to do much more than that. You still got to engage them. You got to make it easy for them. You got to plug into payroll in a very efficient way. And I know that's been a lot of the work that Nest has done. So something may be a non-employer-centric benefit. In other words, it's organized, and run by an arm's length organization, but you're still working very, very closely with the employer to make sure that it works well for them.
And can I just, Alex, jump in on that and say, I think the Canadian example is a really powerful one, and the Australian industry super fund example is a really powerful one, particularly when you talk about innovation. So in an industry that's not maybe seen as all that innovative in a sort of whizzy technical sense, nonetheless, a lot of the really important and powerful innovation in our sector in the last couple of decades has been in the investment space, and driven by first the Canadian plans moving into larger liquid asset classes like public infrastructure, and then followed by big DC profit for member plans in Australia finding ways to do the same kind of thing. And that kind of innovation, which is all about how do you harvest the best possible end outcome for your members in this sense through driving the best possible returns, has been enormous and very much driven by the kinds of institution that you're describing.
Separate than what Will was just saying, but I think it all connects at the end of the day when we're trying to figure out what the future of a retirement system needs to look like. I did mention that some employers by choice, to your point, Alex, might not offer a benefit. But of course, in the US, a lot of the problem is at the small employer level. In that case, it really is sometimes a matter of, there isn't a separate HR function. There isn't enough people. People start businesses because they're passionate about the thing that they do. And to the degree that a third party could take care of a lot of not only the fiduciary role of overseeing the retirement plan, but also just making it much easier because of how it facilitates using the payroll system and everything else. I think there's a lot of folks who really are interested in offering benefits to their workers, but just don't have the right options right now at a potentially an ease and a cost level that actually make sense for the long run for both the employer and the worker. So the kinds of things that are happening in the UK, in Canada, and the idea of these different type of institutions and governance models, I think, are something that the US stakeholders in the retirement system should be looking at much more seriously, especially now that it looks like the open MEP concept could come to fruition through legislation later this year.
The angle that puts into my head suddenly is the use of technology. It's one of the driving forces in society today, sometimes for good, sometimes it gets misused. But that's one of the things that makes certain solutions feasible. Any thoughts on technology in general and how it's being harnessed?
I'll go first with this, but I think that, again, Will and I have lots of conversation around this. And in fact, we were all in Vancouver together at our first effort to do an international conference on a lot of these issues jointly with the ICPM. And the role of innovation and technology in the retirement part of the financial services system has been a little bit more opaque. I think a lot of the potential for technology and innovation is under the hood. It's facilitating removing some of the friction from the system, but not necessarily the kind of innovation that shows up on the front of your iPhone in an app or something. And will speak to this much more eloquently, but pensions aren't exactly the thing that you want to be checking 6 times a day. So it's not really that kind of innovation that we're looking for. But what are look, when I look at the challenges in the system today, we have the coverage challenge that we've talked about. We have this portability issue, though, that is also something that hasn't been dealt with in an institutional way. The degree to which technology could help us to continue to track, identify, mark, connect different savings pots that accrue within different employers, or how do we actually kind of front end solve that problem by creating a more personalized way of understanding where all of your savings exist and how to connect those together. I think that's one of the real opportunities. And I think also there's so much innovation that is possible. Part of the innovation in technology solutions could be on the regulatory side, not just on the private sector side. When I think about, what does it take to understand both the risk and the opportunity of modernizing the retirement system, some of that technology could facilitate innovation on the regulatory side, not just the product side.
I kind of completely agree with what Ida said about, let's not accidentally leap to this is all about apps and user interfaces in a world where you really don't want your average pension saver kind of doing lots and lots of high frequency contact with their pension, which ultimately should be left well alone for as long as possible in lots of ways. Now that's not, there's a whole other discussion to be had about the importance of engagement, and it's not to say engagement is not important, but I think when we talk about technology and fintech, there's a danger that we get carried away on that side of things. Whereas actually I think, I'd maybe point to a couple of other areas where I think there's a huge opportunity with technology in this space. So one is around sort of multi-partner integrations, for example, between payroll software companies and pension providers or other payments platforms, the PayPals of this world and pensions platforms that enable employers and individuals to manage their pensions interactions in the same place as they do other things that are relevant financially, be that payroll or managing how they receive their self-employed income. So we've done a bit of that already in Nest. We have an API for payroll providers that means that they can plug into our system and employers can interact with the Nest system natively within the payroll software they already use, and that's been really helpful, helping small employers find it easier to work with Nest. And it's something we're starting to think about from a Nest Insight perspective in our own program of work, looking at the self-employed to try and think about where are those touch points and service providers in the self-employed universe that might be able to integrate in a more seamless way with a pension provider to make paying money across easier for those who want to do it. And then I think the second one is all around big data, the other kind of big buzz phrase alongside fintech, where I think there's this opportunity to now start to think about which aspects of a default architecture, perhaps particularly around investment strategies and decumulation strategies, can be more personalized to the individual based on what we know about them. So starting to move away from a single default for all the members of a plan to a more personalized or at least segmented default based on the data that we hold. And that's something that I know some providers are now starting to delve around the edges of, but I think will be a big discussion in the next few years.
And one more thing to build on what you just said, Will, I think that we've talked about before is when we think about even addressing this coverage question with expanding savings options for more workers, if those workers are working in jobs that have a lot less predictability to schedule or to weekly income, that kind of can cut across some of what's been most useful in terms of behavioral nudges for savings to date with automatic enrollment and kind of defaulting in at a specific consistent level of savings. It could be that for some of the populations that we now need to reach, that technology helps us think as much about how to take advantage of upside, windfalls when people make money in chunks, and also kind of put things on hold a little bit when money is shorter. So I think that there's another way that, to your point, big data and the ability to look at how tech has helped people smooth their incomes in other parts of their financial lives, how we could bring that into the retirement system is another real opportunity.
Yeah, I'll build on that too. I mean, I think that, one technology, if you can define it broadly, that's been super helpful in retirement savings is payroll deduction.
Yeah.
And so the question of how do you mimic the kind of automatic nature of payroll deduction for people that aren't on payroll, which is a growing group of people, I think is an interesting way to deploy technology as a tool to help with some of those behaviors. So in the couple of minutes that we have left, I thought we could zoom out and think about the future of the system a little bit together. So I'm kind of wondering for each of you, what is your, if you have one, a kind of theory of change about how we fix the system. So if we imagine forward to, retirement systems, say in the US and the UK and other places that are much more robust than they are today, how does that change come about, and where is the impetus? So, to what degree is it government versus the private sector versus kind of the third sector? Is there a sequence in which that happens? Do we know enough about how change happens to even make a prediction on that basis? How do we start? I know there's a series of questions there, but I'm kind of curious about your views on how change happens, and maybe starting with you, Will.
Yeah, so I would say that I think generally this is an area where government has to be the first mover. I think the barriers to individuals kind of electively taking action, and indeed the barriers in the kind of harder to reach sections of the economy, so smaller firms in particular, are so great, and the information asymmetry so powerful between those actors and the supply side that something has to happen at the governmental level to kind of get things moving. But that can be a variety of different things. I think that maybe one of the first big steps here was the Pension Protection Act in the US, just encouraging the take-up of automatic enrolment at a regulatory level among US firms was huge. The UK went a step further and mandated automatic enrolment. I think there's a whole untapped area to think about in terms of how governments spend their money on financial incentives to save. Tax reliefs at the marginal rate are pretty inefficient, I think, as a way of incentivizing behavior. But I think if governments can make that first step to create some demand in those areas where that demand is organically weak, then actually pretty quickly other types of institution, be they third sector, profit for members, or just traditional commercial actors, will quite quickly come in and fill in the second phase and be innovative and find products that work for those people. We've certainly seen in the UK a really mixed economy of different types of actors from all across that spectrum being very active in making the automatic enrolment program work, but they're responding to that demand side intervention that started with government, and to me that's a model that I think is probably necessary in what's otherwise an extraordinarily difficult circle to square.
What are your thoughts on that topic, Ida?
Yeah, I'd agree with Will on many of the facets of what will drive change. I think it's instructive in the US that the reason I wanted to come to Aspen to run this program is because Aspen's primary brand around the world is really about leadership. It's about values-based leadership. It's about leaders from different sectors coming together to both agree on and solve for complex challenges facing society. And in the US, the role of leadership in the retirement and financial security battle is critical. Government leadership is needed, and there's certainly individuals stepping up. We're seeing leadership at the state level to solve these problems. We're seeing more and more people showing up at the federal level as well to think about this. It is a systemic issue, and I'm not sure that market solutions alone can get there for the US. There are market failures in terms of who is served by a retirement system, and unless there is a first mover government leadership saying that this problem has to be solved for an entire population, and creating the opportunities for a marketplace for the private sector to come in and serve, I think that's going to be necessary, and I think we can take a lot of lessons from other countries. One of the most important lessons, though, in addition to it takes multiple sectors working together. These are in other parts of the world, government facilitated but privately led systems. But at the same time, these are long time problems that will take a while to solve. So getting to consensus across leaders that this problem is one that is going to stay priority level number one to actually push across the finish line. That's really just the starting point. And as we've seen with Nest and as we saw in Australia, comprehensive pension reform takes years. And it takes not just partisanship. There's no partisanship in that. There has to be alignment over a decade. And there has to be a deeper level of consensus about where we're trying to set course. So, my theory of change in some ways with Aspen right now is we have to get a broader set of stakeholders agreeing that this particular problem is not just solvable, but is important to solve sooner versus later. And it will take, in addition to the private sector, folks who have always been part of the private sector retirement savings system, it will take some of the fintechs, it will take more community advocates, it will take more government folks caring about these issues. And I think, to the reason, again, to go back to the partnership with Will and to many of the things that we've done with Commonwealth, Alex, if we're going to get started on that process now in America, we might as well go ahead and solve for the issue that's going to be critical for workers' financial security 20 or 30 years from now. And that's going to mean beyond the role of the employer in the system, what's going on with the future of work, what's going on in terms of the ways that technology can facilitate savings, and what are the new kinds of institutions. So I don't want to try to boil the ocean, but I think that if we're going to put a problem out that's solvable, we should try to do the most pragmatic sizing of the scale of the problem and the kind of solution that we can move toward together.
If I could have one more slight change of angle, and that is to remember that the reason why we want more people to participate in this sort of saving, why we want them to do it, is that one day they're going to use that money when they stop working or when they stop working full-time. And so that the question of helping people to have an understanding of the rate at which they can withdraw money to live on it in what I think of as their life two, as opposed to the life one where they're saving and accumulating. Life two is where they're withdrawing it. Do you have any thoughts on the pace at which we're going to find innovation here to help people who don't understand that aspect of using the savings?
I'll give the less technical answer and punt it over to Will on this. I would say this is another area where I think we have two things going for us. One is that we really are at the very beginning of a wave of people retiring who have only ever saved in these defined contribution plans, which have been much better at helping people accumulate wealth and retirement savings, and have in every country not really thought through that decumulation phase, that lifetime income phase. This is another place where I think a lot of new data helps us understand what that spend in retirement might look like. It's maybe a surprise to some, but I know some of the new research has shown that there's still a lot of expense volatility in retirement. The interplay with healthcare costs in the U.S. is huge. It's another place where individual decision-making is somewhat blinded, both in terms of how long you'll live and what your costs are going to be. So I think this is an area for technology and for research. But I think there's also growing political will that this has to be solved. And that leads me to say the other thing I'm hopeful about is that because this is a challenge that we haven't solved in any of the countries that we've talked about today, in Canada or Australia or the UK or the US, this could be an area where we move together. And I do see that this is something where there's a lot of new energy and concentrated focus on the research questions, and also stepping up at people wanting to solve with hybrid income and insurance types of products in retirement. And Will, you can say a lot more about that, I know.
No, I mean, I'd really endorse a lot of what you just said. I think there's a big role for technology and a big role for data, and I think there's an emerging sense that these kind of hybrids of investment and insurance and savings kind of grouped together can play a really important role. And thankfully, I think we are now starting to see some innovation around that. I think the thing I'd add is that Life 2, maybe even more so than Life 1. I think there's an enormous role for well-motivated fiduciaries in helping to figure out the ongoing structure of those products. So it just isn't sensible or reasonable to expect someone who's maybe in their 80s and is reliant on some kind of drawdown-based product to be making good, regular decisions about the sustainable rate of drawdown in their fund, and the risks of consumer harm and the risks of asymmetrical information there are enormous, maybe rather worse than they are earlier on in life, given the role of cognitive decline. So I think these institutions who have aligned interests with the needs of their end investors and are well motivated to figure out solutions that meet those interests will play an absolutely central role in the Life 2 product design world, and that's maybe where we're starting to see some of the interesting innovations coming from now. So it's a watch this space.
Terrific. Well, I think I'm sure we could keep talking for hours about many of these topics, and I know we will separately, but I think that's a great place to wrap up. I know that I found this conversation quite energizing, and if you think about the progress that's been made in both the US and the UK over the last decade in terms of expanding retirement security, I'm really excited to see what's going to happen in the future, what the two of your organizations are going to do together, as well as the great work that you're doing on your own. So I just want to say thank you for joining us today.
I have exactly the same feeling, energizing and encouraging, and I'm just so happy that people like you, of your caliber, of your passion, are involved in this field. This is good for the world.
Thanks. It's been a pleasure.
Yeah, thanks for having us. It's been a great conversation. I've really enjoyed it.
Hi, this is Don. Welcome again to The Personal Touch, that short final part of our Life 2 podcast in which my goal is to take the insights that our global experts give us in their interviews and try to adapt them for the ordinary person to help make your own life better and more practical and more fulfilling. That's my purpose with The Personal Touch. Today's episode is about innovative solutions to retirement security challenges. And we heard from two of the world's foremost thinkers on the subject. So you can be pretty sure that you're up to date on what's en route or anticipated over the horizon. For The Personal Touch, I want to identify what all of that means for you today, before those solutions take place. And my conclusion is that consists of reminders of action steps we encountered in previous episodes. Ida and Will reminded us that for most people, wealth accumulates in home equity and retirement savings. And that prompts me to stress two things. First, make sure you join a plan. If your employer has one, join it. If your employer doesn't have one, search for one that may be offered through your union or other association. Increasingly, workplace arrangements are being made available where there isn't an employer plan. Or if you're self-employed, again, arrangements are becoming available. Search for them. The other angle that struck me was that when you do your calculations to see how much income your assets can provide after retirement, for example with the personal funded ratio calculator on the website donezra.com, remember to include your home if you own it. One other aspect struck me as significant. At Nest, they've tested what happens when participants have their contributions automatically increased. And the answer is, in the vast majority of cases, that works fine. Few go back to the former lower contribution rates. In effect, people simply adjust. See if you can put this into practice. Sign up for increased contributions either every year or every time your pay increases. You probably won't notice it in your paycheck, but it'll make a significant difference when you retire. Also remember what Jonathan Clements told us in an earlier episode. As between emphasizing saving and emphasizing investment, it's better to be a great saver and a mediocre investor than to be a mediocre saver and a great investor. Of course, it's best to be both, but it's easier to be a great saver. Be one. Another message I got from Will and Ida is to automate as much as you can. You shouldn't have to keep making decisions, particularly if they're the same decisions over and over again. And that applies to saving as well as to investing. So, automatic participation, automatic contributions, automatic increases in contributions, automatic glide path election, that sort of thing. Of course, if your circumstances change, or if from time to time you want to review where you stand, by all means check it out, make changes if they seem required. But that's the exception. The rule is automate. And that becomes particularly important in the decumulation phase, where there's the additional danger that one day cognitive decline may set in. Take the time to set up arrangements that will come into effect if that happens to you, arrangements that you set up when you're fully in control of your faculties. It's sad to think about cognitive decline, but it's better to think about it now than to leave it all unattended to until it's too late. For most people in decumulation, some combination of investment and insurance approaches is desirable. I was really happy to hear this confirmed by Ida and Will. All the way through, the notion that growth and safety are both desirable has been something I've stressed. And safety comes in two distinct forms, one being monetary safety, meaning that the amounts we'll get in the near term are predictable, and the other being longevity safety, meaning that we've arranged for your income to continue no matter how long we live. I hope you can check off both forms of safety as well as growth as you review the arrangements you've put in place for yourself. Our experts also noted that most people encounter expense volatility in retirement. And at Nest, they're experimenting with what they call a sidecar account in the accumulation phase. Essentially, that's an emergency fund that's set up for unpredictable expenses while you're working, and they give it priority over retirement saving. In other words, first establish your sidecar account, which in their case is the first £1,000, and then start your retirement savings. Some states in the US are starting the same thing with a target of $1,000. Well, you know, exactly the same thing can be done in retirement. First, establish a sidecar fund, an emergency fund, before you use the rest of your accumulated assets to create a stream of income for your retirement spending. You can make it the same size as for accumulation, so $1,000 or £1,000, or you can make it roughly equal to 6 months of projected spending, which is what financial professionals often advise. And if you haven't calculated how much 6 months of spending will come to, another rule of thumb is to set aside roughly 2% of your accumulated assets for your emergency fund and use the other 98% to generate income. That will also become a source to dip into in times when investments aren't doing so well, and so it's also something you can add to when there's an immediate windfall, because yes, I remember them mentioning investment windfalls and bad times. Now, not much was said about investments, though, as I recall. You know, at least there are target date glide paths typically available in the accumulation phase. Unfortunately, there is no standard set of defaults that have established themselves in the decumulation phase. And I don't have a quick rule of thumb to you. It's too complex for that. What I know is that for my wife and me, I follow the approach laid out with the personal funded ratio calculator on my website, donezra.com. It works for us. I hope it'll help you too. And as I keep saying, it's free and I get nothing from its use. Thanks for listening. Bye.
Thanks for listening to the Life 2 podcast. To purchase Don's latest book, visit donezra.com. And for more information on any of our guest experts, check out Commonwealth's website at cwretirement.com/podcast.